happening. Shiv Puri is joining us right now. He's Managing Director, TVF Capital Advisors. Just to give you a brief sort of introduction, Shiv has been with us in December in 2014 last. Shiv is the Managing Director of TVF Capital Advisors. TVF is a leading FII in the Asian region. TVF has got a focus here in India. Shiv follows the investing principles laid out by Warren Buffett, Charlie Munger. He's a follower, and he's also on the board of the Indian Business Leaders Roundtable. Shiv, it's a pleasure to have you back on the show. Thanks very much.
Thank you for having me.
Good to have you here. Well, since you're coming back after a while, let me set this up by asking you, how are you looking at the market now, the Indian market? How are we doing, and what are our prospects?
I think the Indian market right now is sort of taking a breather, if you will, because earnings have still to catch up. There have been a few companies in the consumer space over the last few days that have done well. Some of the rural lenders have done well. A few of the private sector banks have done well. But in general, earnings for corporate India have yet to pick up. As a percent of GDP, which is one of the favorite measures of how Buffett likes to look at corporate profits, it's at about 4.3% of GDP, which is the lowest it's been in the last 10 years. So the earnings growth has yet to come through, and I think the markets will probably wait for that to happen.
But the market has not been held back, so to speak, right? I mean, very resilient. We've not seen any large, meaningful selling.
Yeah, I think, if you look at the market as a whole, it's been roughly flat on the year, especially in dollar terms. So I don't think there's much that's happened in the first half of this year. And like I said, I still think there's some more time to go, a few more quarters to go before earnings for the market as a whole can pick up. And but having said that, individual sectors and companies within that, some of them are doing really well in a 4.5–5% real GDP growth rate, and will continue to do so.
Now, okay, in terms of the valuations, etc., at an aggregate market level, how are things looking? I mean, the PE keeps moving because the E doesn't expand, or rather the E gets cut it's been now being cut every quarter, right? Last quarter was pretty poor. Fourth quarter, maybe this one will be slightly better. But how is the PE looking?
I think on valuations, you can see the market trade at, call it 15 odd times earnings, 15.5 times forward earnings. But I think this time it's very important to look into the details of that. And for example, the FMCG index of companies is trading at 35 to 40 times, while on average it's been in the 25 times sort of range. So if you look at the index ex-FMCG, for example, it's trading at 13 or 14 times. So I have to look at it on an individual sector and a stock basis, because the divergences are pretty large. Obviously, the commodity companies are skewing the earnings down because of the global decline in commodity prices. One important point on valuations is it's important to look at valuations in the context of operating margins, because that's what determines earnings. And today, operating margins are, in our estimate, anywhere from 25 to 30% below their long-term averages. And that's because we're coming off a period of high inflation and high costs, and demand is yet to pick up. So the moment the demand picks up, you're going to get operating leverage, and as a result, you will see the benefit of that happen. So I think another way to look at it is to look at cyclically adjusted earnings, and at this point, the cycle of earnings is low.
Okay, so operating margins can improve, and that's the trigger. Earnings, that if you look at the first quarter earnings so far, margins actually are not the problem, really, right? I mean, the companies are being able to squeeze out more from their earnings, and margins are pretty healthy. From historical average perspective, they're still lower, as you're saying, but that's, as capacity utilization picks up, you'd see the benefit of it. That's the point you're making, right? Shiv?
Yeah. So, margins for companies that have, input costs, obviously in the commodity sector, they've held up because commodity prices, oil prices have come down a lot. But the margin benefit that companies should get from an uptick in demand, that is yet to play out.
Okay. Now, again, I'll just get to the, you're a Buffett follower, and Buffett doesn't, I mean, when asked what is your view on rates and economies, I don't know, right? I mean, he'd go straight to stocks, but we can't go straight to stocks. We can't talk about, I'd love to, but let me just, before I approach sectors, etc., let me just ask you, what's your, what's going to change in terms of propelling demand from here? Broad-based demand sort of pickup, Shiv. What's your view? Is it going to happen? Are we near it?
Yeah, you know, I think there are a few things that are holding us back right now here. I think the one thing is that we need the infrastructure side of the economy to pick up. And in my view, the government's doing a good job in pushing some of the things on that front. But the private sector is not up to executing today because of the indebtedness on the balance sheet. And I think that is something that still needs to be worked through. The state-run banks are unable to participate in the infrastructure sector today in any meaningful way. They are 75% of credit in this country and probably a larger percent on the infrastructure side. So that vacuum has to be figured out somehow, and I don't think it's being addressed. That's one big area, one big engine of growth that's still not anywhere near where it should be. I think the other thing is that you know, people talk about interest rates, and I don't have a view on where it's going to go. But monetary policy is tight here, and you know, one can argue that people now want to look at the CPI and not the WPI and things like that. But given the decline in commodity prices, given the fact that rural subsidies are no longer going up as fast as they were in the past, the MSPs of agricultural products are not going up at the way they were in the past. You know, I think there is probably some room on that front, and I think these two things are still holding the economy back.
So, are you saying that not enough is being done on the infrastructure side, or are you saying, well, it's not, the sector isn't responding?
I think there's more that needs to be done on the infrastructure lending side, on the lenders, especially the state-run banks. You know, so far what's happened is that the government's infused capital in the top 8 or 9 state-run banks, depending on ROA. That's a great incentive system, but unfortunately, since they are such a big portion of lending in this country and they're not in good health, until they're not able to lend, it's hard to see how infrastructure growth will pick up.
You know, but PSU banks all tell us all the time that there is no real demand for credit. It's not as if people are queuing up for loans. So they might not have capital, but at the same time, there's no demand.
Well, it's because there's no demand because the balance sheets are over-leveraged. So they can't take on corporate balance sheets in the infrastructure space only, not in corporate India. But in the infrastructure space, the demand's not there because they already have a lot of debt on them.
So then, I mean, what's the solution? What needs to be done? So is everything which needs to be done being done, and yet it's not responding for some reason? And that something could be demand, real effective demand, which isn't maybe as strong. So it's not all about corporate leverage, etc. Maybe you know, industries don't see that much potential to set up new plants, new factories and things like that. So it's not just a leverage and funding issue. It's basically seeing prospects to make a reasonable profit over a period of time as well. I mean, that could be the issue. Or you think otherwise?
I think otherwise, because I think infrastructure-related demand in India still has a long way to go. Whether you look at the road sector or the power sector or the manufacturing sector, there's a lot of scope left in India. So I think it's really a supply choke. It's because of the supply that it's not happening. And of course, you know, ease of business and things like that are a big factor in it. But I think today the lenders are not able to participate. The borrowers are indebted, and you know, I think that solution does get fixed. I mean, the government's announced that they're going to infuse some capital into the state-run banks this year, some more next year. So slowly it'll get unclogged. But I think that's the part of the economy that when it starts coming online is when you get the next leg of growth.
Shiv, but as you said, there's no demand for credit. You agreed with me, there's no demand for credit because borrowers themselves are indebted, right? So then what good will it do to infuse PSU banks with more capital? Send good money after bad? Is that the solution?
No, I don't think that's the solution at all. First of all, borrowers only in the infrastructure sector are over-indebted. I don't think if you look at corporate India across the board, I think balance sheets are in great shape.
But we're talking about infrastructure.
So on
in
the
particular,
infrastructure
right?
sector, you know, if borrowers have, you know, large amounts of debt that are due in the next couple of years, but the projects got delayed and is not coming online for a longer period of time, how is that borrower expected to raise more capital and grow? The bank, on the other hand, wants to ensure that they get their capital back. And so they're sort of in this you know, quagmire, if you will, where I hope some solution can be found.
So the money has got to ease up, Shiv, right? You bankers have got to take more risk and bet on promoters and plans, etc. A little more, be a little more enterprising. That's essentially what easy money does, right?
It's a bit of a chicken and egg problem. I don't think the banks have come off a very difficult experience of lending in the infrastructure sector. To tell them to take on more risk in this space is not something that
exactly.
They're going
but that's what's required in a way.
But what I think is required is to ensure that viable projects get funded, that there is some equity capital that gets raised in these projects, and some of these are actually, you know, seen to fruition, which is not happening.
Yeah. Okay. Fair enough. Now let's just so that's the macro and top-down kind of way of looking at things. You're saying that infrastructure is still not picking up, and you said the rural economy is not doing well. Although you did hear from the Godrej Consumer Management on rural India, and they said the rural growth, volume growth is 16%. So that's very, very strong. Let's get to your way of looking at sectors and investable sectors in a way. What are your top bets, Shiv?
So, you know, again, our view is always to look at things on a bottoms-up basis.
Yes.
And really, from a sector basis, we still think that the private sector financial lenders, which are both the banks and some non-banking financial companies, have an excellent runway of growth for the next, you know, 5 to 10 years.
Okay.
One of the reasons that this time it's more interesting than the past is that what we talked about earlier is that the state-run banks still have a lot to do to repair their balance sheet. But even more importantly, they're falling behind in terms of technology. And that, I think, is something that you know, most of the private sector banks are doing a pretty good job of. So, you know, select private sector banks, rural housing we continue to like. We've something that we've liked for a long time. And you think the growth out there is
lenders to rural housing.
Yes, the rural housing lenders.
Okay.
We think they're a very attractive area. You know, I've said this before, but I think pharma continues to be a very good area for a very long time in our view. We've always said that the chemistry skills in India have finally hit a level where, you know, they have the ability to grow and you know, quite rapidly in the years to come. So these are a couple of the areas that you know, we find interesting at this point.
Okay, I'll come to these in a bit, but anything new, interesting that you have picked up, because all these were on your list in December as well. It's not necessary to have new ideas. You could have old ones and just to find. But anything else that's become interesting suddenly? Any opportunities?
You know, I think there's a lot of work that you know, we're doing in the auto component space, for example.
Okay.
There are companies out there that we feel can become big global players. And remember, globally, the auto component companies have consolidated, unlike the global car manufacturers. So the bargaining power has shifted. That is an interesting area. IT services is something that you know, the big strong companies are getting stronger, and you know, we think that the whole shift that's happening in IT services towards social mobility, analytics, and cloud, this is a long-term trend, and the people best positioned to capitalize on that are the existing embedded IT services companies. So these are areas that I think are promising going forward.
Okay. What about, I mean, consumer staples, consumer discretionary names, domestic facing companies?
I think the consumer companies are, especially the ones that have great brand names, are doing fine. As you mentioned, a company that you just talked about. The issue with consumer companies that we're finding here is that valuations are are very high, and they've been significantly higher than where they've been in the past. And I think one of the reasons for that is that people are unable to find growth elsewhere. And so wherever they find growth, there's a very high premium that's been put on that.
Yeah. But isn't it true in most areas?
It's true, but I think in the FMCG space, it's dramatically extended.
I mean, so the only problem there is very high valuations. Is that what you're saying?
Yeah, I think that is one of the main, that is pretty much the main problem, because they've got the benefit of lower commodity prices, which has helped. Some of that they've passed on, and some of that they've retained in terms of better and showing better margins. So I think that, yeah, valuations is one key element over there.
But there's no market growth type of problem. That's not an issue.
Well, if you look across the board, volume growth has been reasonable. In most cases, it's been double digits, which I think in this environment, volume growth of double digits with some pricing power is pretty good.
As Buffett says, Shiv, wonderful business at a slightly expensive price over a period of time, you'll do well. Doesn't...
But he also says price is what you pay and value is what you get.
Yeah, he does. So, okay, so consumer, so that includes everything, right? Staples and, I mean, autos and paint companies and all those things is what we're referring to. Or is there any subsector that you still think offers value?
So, I think there, across the board, the valuations are high, but, in certain areas, one should balance that with where they are in terms of their long-term margins and where the margins are today. Because I think, again, when demand picks up, they will get operating leverage. Still, it's hard to find value there.
It's hard to find value. Okay. So let's just cross out a couple other sectors. Commodities, strict no-no?
We've never looked at the commodity sector. I think one of the things about investing in countries like India is that you want to try and capitalize on the domestic story. You want to try and capitalize on domestic growth. So commodity is not something that we've ever looked at.
What about the luxury car market in China, since we can't talk about stocks?
I think your guess is as good as mine. But
you're based closer to China, so you've got a better sense.
But I'm no closer to the luxury car market than you. So no, I don't know that space at all. I mean, I think the risk is not with the luxury car market, but there is a macro risk with China.
Okay.
And not going back to the macro right now, but I think if there is one contagion that can happen, and it's China. So we need to be a little careful on what's actually going on the ground over there.
Do you feel it's a big issue, or because I mean a lot of people, saying, well, they don't make the mistake of saying, well, the market and the economy have got anything to do with each other in China, and now I mean a lot of the same people are sort of coming down to the fact and they're saying, well, it does make a big difference to the economy eventually. I mean, so.
I think in China it's an opaque issue, which is a real problem, and it's the size of the issue. It is such a big economy, and there is so much leverage that is there in the economy that you just don't know where the second and third degree problems can arise. So I think it's more of a fact that nobody really knows. It's so opaque that makes it a little worrisome.
What about telecom? What about media in India?
In the telecom sector in India has been very difficult for a long time. And, at one point it appeared that the market was going to consolidate. And then, of course, one new large player is coming into the market and launching as we speak. And I think that alters the economics again for a lot of these telecom companies. However, if we look at the telecom tower space, and I think that's a lot more interesting. Because there it's like owning real estate. It's hard to put up another tower. The economics don't make sense. The approvals are difficult to get. And as you move from 2G to 3G to 4G, once you already have the real estate, which is the telecom tower, and you put more equipment on it, it's more rental for the tower company, but it's no additional cost.
But, is there something we most seem to be missing there? Because stocks seem to be doing very well, even though the launch of a large competitor is imminent. both Bharti and Idea. I mean, and the run started when spectrum auctions were happening and exorbitant prices were being sort of signed on, and well, the stocks just kept going higher.
Well, I think if you look at it on a last few months basis, they may have gone up. But Prashant, if you look at it on any multi-year basis, on a 4 or 5 year basis, I don't think there's been much wealth creation that's happened in those companies.
Broad range, trading type range, right? I mean,
that's right. And you know, it's a very difficult competitive space. And you know, what Buffett says is that his most important metric is not the utility of the product. We all have mobile phones and we use it immensely. We also fly, but that doesn't make airlines a great business. But it's the competitive nature of the industry. So you know, he likes investing in companies that there is less competition, where the good companies are increasing their moat against the competitors. Whereas you know, the telecom, airlines, some of these businesses don't display that.
So I guess I shouldn't ask you about media, right? Sure. And you've answered the question.
Right.
Okay, all right, fair enough. So that's that. Let's just come to what you like right now. And I've been sort of going all over the place and asking about things that you don't particularly like. Private banks now. Are valuations a problem at all? The larger ones? It's a large market and they're gaining market share. That's the basic story. And they will continue to gain market. Public sector banks, as you said, are pretty weak. But there are two issues. One is valuations, and B, if the economy doesn't recover, the old story, as the old argument that how can private sector banks continue to do so well, grow loans at 30-35%. The last one to report was yes, loan growth was 35%, advances were 35%. I mean, those things will come back if the economy doesn't improve. And now there are specific issues. The steel sector, for example, is under a fair bit of spotlight. You've had issues like, say, for example, Jayaprakash Associates. And this is just scratching the surface. I mean, for all the, talk about bad loans and indebtedness, no large corporate group in India has actually seen any real trouble. It could happen, and is that going to come to worry some of these names, private sector financials?
I think there's a couple of points here. Number one is that some of the well-run private sector banks have been recognizing these as provisions in their books for a while. So they're not carrying any of these loans at par. So some, because we are 2-3 years into this cycle, there probably will be some that go bad, and there's probably some more pain to come. But I think by and large, the private sector banks, and again, not all, some specific private sector banks out there have done a pretty good job. And when you're talking about loan growth,
so are you talking about retail-focused private sector banks mostly?
Retail-focused private sector banks, even SME-focused banks, except those that have done the large ticket infrastructure lending. The rest of them have done a pretty good job underwriting credit. And if you look at the SME sector and what the non-performing assets are in some of the good private sector banks versus the state-run banks, it's a dramatic difference. So I think that the loan growth here that is coming for the sector as a whole, the sector banks as a whole, which is in the mid-high teens. This is a backdrop of a weak economic environment, and an environment that over the last few years has been tough. I feel when the economy picks up, they will do better. Regarding valuations, I think if you look at many of these private sector banks, they are trading in line with where their long-term historic valuations are. And you just look at the size of the opportunity. I think it's huge. I mean, at the end of the day, India is a true $2 trillion economy, and the largest private sector bank has a market cap of 40 billion. So I think there's a huge runway to grow over here.
Now, the government has focused on specific sectors, right? I mean, coal, for example, is a monopoly. It wants to fix the power sector. Infrastructure, rail, ports, roads, etc. is playing a big role. Banks is another area. So far, we haven't seen any commitment. I mean, there was some 10,000 from the last budget, and maybe more will come. But if the basic underlying issue for being very bullish on private banks is that they'll continue to, take market away from PSU banks, is the government and what they're willing to do with PSU banks a risk at all, or no? Even if they, sort of get fully behind PSU banks, the trend is kind of irreversible. Would you go to that extent?
Well, see, PSU banks have been losing about 2% market share a year for over the last decade. And that's how the private sector banks are at 25% market share today. I think it's a very big uphill battle for the PSU banks. Even if the government were to put capital into these banks, it's going to take them a couple of years to fix the balance sheet. It's not going to be an overnight process. But second is, what I mentioned earlier, which is digital. A lot of the private sector banks are making big headways into this. One of the largest private sector banks announced that they're now seeing more of their business happen through the internet and through mobile than even through the ATM machines. I think there's a lot of catching up that the state-run banks would have to do. So these are difficult issues for them to come to terms with.
Okay, all right. Mortgage financiers, Shiv. So you like the same ones, which you liked? Would you mind telling our viewers what do you already own, not what you're planning to buy, but what's in your portfolio?
Without going to specific names, I think the mortgage finance companies targeting towards rural India, the low to mid income, I think it's a growth opportunity for a very long time.
But aren't they all mostly in that segment? I mean, in the average loan size, 10 to 15 lakhs, maybe even lower, actually, 7 to 12 or, yeah.
Well, first, the numbers that are there are not very large. I mean, there are about 7 or 8 lenders for in the whole country. So, once you hit the 20 lakh and above is when you come up with the larger, more well-known players. But I think in the 15 lakh number and below, there are about 7 or 8 players, and that is the sweet spot. Now, within that, I think it's also important to look at rural lenders that are focused on a particular geography, because there are some that are trying to become pan-India and grow dramatically. And we know in banking, it's quite local. You need to understand the consumer really well. So there are a couple of companies, one in the west and one in the south, that are very focused, growing organically, and I think the opportunity out there is very large. According to the one of the studies by the NHP, there is a shortage of 18 million rural housing units. Now, I don't know if that number is 18 million or 30 million or 10 million, but even the largest of these rural lenders have lent to about 100 to 150,000 units. So, you just see the scale of where the opportunity going forward can be.
Okay, all right. And the third one is pharma. Anything new there without being very stock specific, or is the large ones?
Pharma is a good opportunity right now, I think, because a lot of the companies, the well-run companies, have had an issue with the US FDA.
So you're seeing these as buying opportunities?
So, I think the best time to buy or invest in a great business is when it's going through a temporary period of problem, as Buffett says as well. So, I think this is an opportunity. They will overcome this. And I think they, this is a great sort of long-term area.
So Shiv was talking about Group Finance and Repco Finance earlier. He can't talk about stocks, I can. And in pharma, he has bought Sun Pharma and Lupin recently. Speak now, Shiv, if you
can say what you want.
Must. All right, now I'm just joking, but yeah, I mean, he's kind of sort of very nicely outlined the construct, private banks, mortgage finance companies, and pharmaceuticals, and he's explained the rationale there. Just one more space before I let you go. Auto components, Shiv. You said you think that some companies can get global scale and become really large. Any specific segments that you're referring to without going into companies?
So, in the first wave of auto component companies from India, what they tried to do was essentially dismantled plants in the West and put them up in India and had a model where they would be able to do it at lower cost.
Okay.
Unfortunately, that didn't work because execution was a big issue. What is happening today is there are certain companies that are able to build an expertise in a certain area. And I think those are the ones to look at. So there are certain auto component companies that I think have that level of dominance, not only within India, but even increasingly outside, which I think are interesting. But the one caveat in auto components is there are a lot of commoditized manufacturers, and I think that's that's very difficult business.
Okay. All right. Fair enough. Across these companies, do you have a market cap threshold, Shiv? I mean, in your funds, that this is the minimum size that these companies need to be before we start looking at them, or not really?
No, I don't. There's not really.
There's
any,
nothing.
Yeah.
There's okay. All right. Fair enough. Let's wrap this up, Shiv. Thank you very much for coming in. Good speaking with you, and good insights as always. Hope to see you back soon again. Thanks indeed. Shiv with TVF Capital and that perspective coming in. We're going to take a very quick break here. We'll come back in 2 minutes and we'll be speaking with the management at Castrol, which reported numbers yesterday. Mr. Ravi Kriplani is Managing Director with Castrol, and you will hear from him when we return.